Throughout the past few months, we saw three banks collapse, including the Silver Valley Bank. This led to many other banks to fall in stock price, opening a possible opportunity to buy bank stock at a discount price. One of such banks is US Bancorp, ticker USB, which is currently trading at $29.65, and over the past month it is down by almost 17%, and over the past 6 months they are down by nearly 31%. Now, many banks are still at the risk of collapse, and even though they are trading at very low prices, the risk outweighs the reward. But this might not be the case with all regional banks, and therefore today we will have a look at US Bancorp and evaluate whether it is a good idea to buy it at its current trading price. Now, the first thing we must understand is what leads to a bank's collapse. The main thing that can lead to bank collapsing at the current time is the lack of liquid assets, and that is also the reason why SVB went under, as they did not have enough liquid assets to return to depositors. Though this is not the case with US Bancorp, which currently has a 122% liquidity coverage ratio, which means that the bank has nearly 25% more cash than it needs to reach the 30-day demand, being capable to return money to its depositors without getting into serious trouble. Now, to analyze USB further, I have created fully automatic sheets specialized for financial companies, which will allow us to evaluate USB's financials using the 9-pillar analysis and find its intrinsic value using the Graham's formula revised, price to tangible book value, multiples valuation, and the dividend discount model, and all these valuations will lead to our ultimate valuation at the end of the video. Now, to return to the stock screener, we will plug in the ticker USB and all the metrics will show up automatically. And right away we can see that the current dividend yield of USB is sitting just below 6.5%, and the dividend payout is sitting at $1.92 per share per year. Now, the dividend yield is so high because of the current low price per share of the stock. Generally, the yield of USB would be sitting between 3 and 4%. We also have the trailing payout ratio, which is sitting just below 40%, a very decent payout ratio indeed. The analysts also project the price of $53.41 by the end of 2023, which is more than 50% higher than the current trading price. Now, the institutional ownership of USB is very high, and the beta of the company is sitting below 1, meaning that you won't see as much volatility as you would with the overall market. And if we direct our attention up here, we can see that the total assets of USB are sitting just below $675 billion, which makes it the 7th largest banking institute in the US. But now we can move to the 9-pillar analysis and evaluate USB in a bit more depth. Right away we can see that the price to tangible book value is sitting at 1.45. Generally, we like this metric to be below 1, as that indicates that the stock is undervalued. We also have the 5-year PE ratio and the price to free cash flow both sitting at very decent values, and we have revenue, free cash flow, and net income growth over the past few years. We also have decreasing shares outstanding, which means that the company is currently buying back shares at this very low price, which I very much like. The long-term liabilities over the 5-year free cash flow negative dividends is also sitting below 3, sitting at 1.78, which means that the company can pay off most of its long-term liabilities in about 8 years or so. They also have consecutive dividend growth of about 10% annually, which is great. But now let's move to calculating the intrinsic value of USB. First, using the Graham's formula revised, we will take the earnings per share, which we will multiply by the average yield on AA corporation bonds, and we will multiply that by the sum of the base PE and the multiple of the 5-year growth estimate and the growth rate multiplier. We will then divide all that by the current yield on AA corporation bonds to get an intrinsic value of $68.71, 57% higher than the current trading price. Now we can move to the next valuation model, the price to tangible book value. Here we take the historical price per share, historical equity value, and the historical shares outstanding to calculate the historical price to tangible book value, which we compare to the present value of tangible book value and get an intrinsic value of $38.23. Now, what this model basically does is that it compares the historical price to tangible book value to the present value of that price to tangible book value, and therefore finds out how much a company is undervalued or overvalued compared to what it has been trading in the past. Now that we have found the intrinsic value using the historical price to tangible book value, we can move to the next valuation model, the multiples valuation model. And here I will be comparing USB to TFC, PNCA, and ING. I took these companies' current stock prices and found their book value per share. I then calculated their price to book value and arrived to an average price to book value for all of the three companies. I then compared this price to book value to the price to book value of USB to arrive at an intrinsic value of $22.58, which shows us that USB might be slightly overvalued to the other companies we are comparing it to. But now let's move to our final valuation model, the dividend discount model. Here the program plugs in the dividend payout over the past 5 years and calculates the average growth rate to be sitting at 6.84% annually. Now I project a future growth rate of 4.4%, and of course USB pays out its dividends quarterly, so we will plug in a yearly dividend frequency of 4. Now using the projected growth rate, I calculate the next year's dividend, which I take and divide by the WACC negative the projected growth rate to arrive at an intrinsic value of $76.79, which is currently quite a bit higher than the current trading price. Now we can move to our ultimate valuation, where we average out the Graham-Stromial multiples valuation, historical price to tangible book value valuation, and the dividend discount model to arrive at an ultimate intrinsic value of $51.58, about 73.96% higher than the current trading price. Now even if we plug in a margin of safety of 30%, we still get an acceptable buy price of $36.11. Now if we try to plug in a safety margin of 35%, that would still be a buy at $33.53. As you can see, the intrinsic value of USB is quite higher than its current trading price, but if we jump back to the price graph, we can see that at its peak, USB was indeed trading around $50 a share. This shows us that investors might indeed be overreacting, and US Bancorp might be a great buy at its current trading price. Now if you are indeed going to buy US Bancorp at its current trading price, be warned that it is indeed a risky investment, as no one knows what is going to happen in the future. But of course, the more riskful an investment is, the more return it can possibly yield. If you find the spreadsheets helpful and want to download them for your own use, you can access them at my Patreon at the link in the description. With that, if you enjoyed the video, make sure to leave a like and consider subscribing, as it really helps the channel out.